Welcome everyone. This simple math calculation have destroyed many potential real estate investors in the past and will continue to destroy many real estate investors moving forward unless you watch this video and we will educate you, inform you. I promise by watching this video and digest our information, Julie and I are going to save you hours and days and weeks and months and years of research and due diligence on how to pick the right property. You have to crunch the numbers. We have to apply the right formulas. At the same time, you do not need to become a mathematical genius. I'm talking about sixth grade math. This is Seewing Yi from the Yi Business Network, and my co-host is Julie Bless. How are you, Julie?
Good morning, Seewing. I'm doing well. Thank you.
For those of you in following my videos, Julie is a regular co-host because she always provides great perspective. But many of you are beginning investors. Many of you have purchased several rentals in the past and want to ramp up, want to learn more, want to take more action to achieve your financial dream. And Julie, she quickly, let me go through her background. She had a very late start in real estate investing. We're not going to go into that, but several years ago, she really ramped up her portfolio acquisition a few years ago, and now she has a total of 6 rental properties in the Midwest, cash flow, and arena appreciation in Buffalo, New York. And even if Julie will do nothing else, which is not going to be the case, her monthly passive income is around $2,000 to $2,500 monthly net positive income coming from those 6 rental properties. She can do more. She's not done acquiring properties. It does not take much to make this happen. You got to take action. You got to do the work and just continue to be consistent.
That's correct. Absolutely. I think the last thing you said, take action. That's the most important step. All the information in the world won't buy your property if you don't take action.
Exactly. All right. So today's topic, we can go do a very deep dive on a property analysis. Now, many of you are thinking over the years, if you are, some of you are seeing, Zillow's top 10 housing market. Here are the top 10 locations, or Redfin 2024 top 10 market, or Fortune magazine top 10 or top 15 real markets. Then a unsophisticated investor to go into a particular market thinking, hey, if sources say it's good to buy in this market, then let's dive in, let's take action. But it's more to it than that, and I'm going to show you why. So today, I'm going to focus on Las Vegas. Even though we could evaluate a real Las Vegas single-family home, you could make the argument this price point are very, very similar in Las Vegas or in Seattle, Washington, or in the suburbs of California even, or in Phoenix, Arizona, Boise, Idaho, Austin, Texas. These are robust Sun-Belt market. Again, you have to crunch the numbers. You have to do a deep dive to determine whether it's a good purchase. The thing is, it's all about cash flow. Foundation of buying a rental property is buying for cash flow. Of course, there's more to it than just cash flow. But let's go with this starting point. Now, I took the liberty of taking a medium price home in Las Vegas. By the way, in case you do not know, in my opinion, Las Vegas, not now, very soon will be the fastest growing housing market in the country. This is just purely based on my opinion. The reason, because the Las Vegas median price of a single family home is around $450,000, $500,000. And it's very close to housing shortage, rising demand. Las Vegas is the entertainment capital of the world. It's a very robust economy, and it's a very diversified economy. When you look at the sports teams alone, I'm a sports fan, and I know all major sports. Las Vegas about to have a Major League Baseball team. They already have a Las Vegas Raiders football team. They're going to get an NBA basketball team very soon. They have a hockey team. They have a professional soccer team, I believe. They have Formula One race car event every year. And there's a speed train, a bullet train being built in the next 2 years that will take people from Southern California to Las Vegas 3 hours each way. This logistical hub, this transportation hub, will bring even more people from California into Las Vegas. So, Julie, you agreed with all this growth, all this infrastructure, Las Vegas with no state income tax or for residents, and the robust market, entertainment capital of the world. You agree that Las Vegas will continue to grow?
Absolutely. And I'm just thinking when you're talking about all these different sports teams and things that are going to be coming, like we had talked before about the whole midterm rental market, that'd be a great opportunity for somebody to take advantage of that midterm rental market.
Yeah. Also, you live in Southern California.
That's far away from me.
So Californians are escaping the high cost housing market. Cost median price for homes somewhere in Southern California, LA, Orange County, or San Diego. Median price for a single family home is around $1 million.
Right.
Right now, to drive 3 hours, 4 hours into Las Vegas and buy a house half the price, right?
Oh,
So,
absolutely. Oh, yeah, less than half the price. That's a beautiful home. For
I,
right, that price would be probably closer to 2 million in California.
yep. However, I caution all of you out there, not so fast. Okay. Not so fast. You need to do some calculations and I'll show you. Okay.
Mhm.
I took the liberty of evaluating this particular house, how to buy in any market, not just Las Vegas. Make sure you cash flow, make sure you the whole 9 yards. Let's dive into it. So this property, cookie cutter, 3 bedroom, 2 bath, 18 square foot, price at 460,000. And so as a risk investor, how are you going to evaluate? How are you going to make a decision what you buy this property and how much down payment? What are the numerical formulas? What is the capitalization rate? What is the rent to value ratio? What is the cash and cash return for you to make an informed decision? So let's dive deep. This presentation will shock you. A lot of so-called sophisticated investors still do not know how to do a proper numerical evaluation, let alone a newbie, someone who buying a rental property for the first time,
Right.
are into on this kind of market. You are in for a rude awakening.
Right.
Okay.
Right.
All
Mhm.
right. All right. So there we go. Upon further review, my further research indicate that this house in this neighborhood rents for around $2,000. It's pretty realistic. Okay.
Mhm.
$2,000 monthly gross rent and a price point of 460K. So let's keep that in mind. When I use my property tracker, and Julie, you and I use property tracker quite
Yeah.
often, if you are a serious risk investor, you need to have some kind of software that have this kind of
Oh,
features.
absolutely.
You don't have to buy property tracker. I subscribe to it every month. Julie, same thing.
Oh
We
my God. It made such a difference doing my taxes this year.
Yeah, that's a real estate software calculation that allows you to do the numerical analysis. By the way, even though I'm talking about Las Vegas, this type of analysis goes well with many markets like Phoenix, Arizona, Southern California, and suburbs, some in Dima County or wherever, or Northern California and Sacramento. These type of houses, these type of numbers, pretty similar. And Boise, Idaho, and Austin, Texas, and Denver, Colorado, and Phoenix, Arizona. That's what you're looking at. So even though I'm talking about Las Vegas specifically, this type of analysis is applies to pretty much India in the western region, the Sun Belt region of the US. Am I right?
Right.
Do you
Right.
agree with that?
Yes, I understand what you're saying. Mhm.
Okay. Okay, let's dive in. All right. So you and I, Julie, agree. When people say the word cash flow,
Mhm.
comes to mind. Before you answer, Julie, when somebody talk about cash, this definition is being used quite consistently over the years. Okay, the way I describe cash flow is if I would have put 20 to 25% down payment, and at the end of the day, I expect some kind of cash flow whereby the rent I'm collecting exceed all the sums of the mortgages, taxes, insurance. At the end of the month, we get some kind of monthly positive cash flow. Could be $100, could be $300, could be slightly more. Okay, that's the benchmark for cash to the 25% down payment. Julie, you agree with that?
Oh, absolutely. I think that's about what we did. Of course, our properties weren't nearly the close to the price here, but yeah, I think that that's the best. When I think people think about it from an investor standpoint, yeah, they're planning to put down at least 20%.
Yeah. Some people are going to make the argument, oh, I'm going to buy only for meaningful appreciation. I don't care about cash flow. Well, careful what you wish for because you could be, you do something like that and you can be on your way to the poorhouse. All right. So let's use the benchmark at 25% on this single family home investment property, on this particular real property. So 460,000, you put 25% down payment. So out of pocket is around $115,000. $100,000 down payment.
Right.
You will pay a mortgage rate of 7.3%. Because today's mortgage rate, according to Mortgage News Daily, the website, today's rate is 7% owner occupied rates, but investors you have to pay higher rates usually on a loan, on a 30-year fixed rate loan. I use the projection of 7.3%. At the end of the day, 25% down payment, 116 grand total out of pocket, with the rent being $2,000 at the end of the month. What is this? What is it showing you? What? Tell me, Julie, what do you see here?
It looks like a negative cash flow right there.
How much?
$1,400 and almost $50. $1,450, $1,449. Yes.
As an investor, would you be able to digest this number?
Probably most people would not. They would not see the advantage of taking something on with a negative cash flow.
I wholeheartedly agree. Somebody will argue with me, hey, I still like to buy this kind of property. Well, for this price range, I don't care about $2,000 monthly rent. I'm going for appreciation. Okay, I'm going to make this a cash flow property. Okay, what do you mean? Okay, then I'm going to say, what do you mean you can try to make this a cash flow property? Okay, let's run that scenario. Let's put 50% down payment. Okay, 50% down payment multiplied by the purchase price $460. So down payment is $237,000.
Right.
Same 30-year fixed rate mortgage rate, 7.3%. Run the numbers. Your gross rate of $2,000 minus the property taxes, minus insurance, minus vacancies and maintenance and upkeep. You get 7%. What have you? At the end of the month, you commit to $237,000, 50% down payment. Monthly net. What is it? What is your?
Still showing a negative, but it's come down. It's $661.
I tell you what, personally, I would not feel good. We'll have a negative cash flow of $661. Rent to value ratio, best case scenario is 1%. I know it's very hard to get 1% rent to value ratio. 1% multiplied by the purchase price equal to monthly rent. You're not going to get that in most part of the U.S. market. I get it. But with a 0.4% rent to value ratio, it's not going to meet my expectation. Capitalization rate, 2.4%. If you know what capitalization rate is, it's your net operating income minus your annual debt expenses divided by the purchase price. The benchmark for cap rate is around 6%. You're getting 2.4%.
Right.
Cash on cash return, minus 3%. And the total return on your investment, your 50% down payment on the $230,000 property, getting 3% ROI. I might as well put my money in the money market or CD. Or leave it in a bank, earning whatever, low 2%. You get that. And you come out with a negative $661. No, that's not going to cover for me. The numbers does not make sense. I'm not going to be in a red. Let me go through the scenario. Some investors out there think, oh, they don't want to make a cash flow. I don't care. I don't care about these formulas. I'm going to put more money down. Of course, the more money down you put, the more cash flow you can get. Okay, let's run that scenario. So we're running into several stubborn investors based on my scenario. All right, so instead of putting 50% down payment, let's put 80% down payment. 80% down payment is $322,000 down payment. And you get a loan for 20% loan. What's the monthly cash flow?
Not quite even break even. It's less than it's $30 negative.
Yeah. So the numbers purely based on logic, based on common sense.
Correct.
I'm not going to buy, even if I have money for down payment, and a lot of people do not.
Right.
I'm not going to commit to a huge cash infusion or just to barely break even on a monthly cash flow situation.
Yeah.
Right. Then this investor say, I want to buy Las Vegas. Las Vegas is a fastest growing city. It's a very good place to buy. I want to buy this house. Okay. I want to make a cash flow. Okay. Let me run the last scenario. The benchmark is always 25%. That's the benchmark for real investing. So the last scenario, I was like, okay, let's buy all cash. Let's put in all cash. Let's put in $500,000 of your money, all cash, to buy this property. At the end of the day, net rental income and your gross rent $2,000 minus your property taxes, insurance, vacancy, 5% vacancy, 7% maintenance. Finally, get a monthly cash flow of $915 per month, and annually is around a little bit less than $11,000.
Right.
Let's do the math, Julie. You put in almost $500,000 of your money or cash to get a $11,000 annual net cash flow. So just do the math. 460 divided by 11,000. What is your return? 2%. 2% return.
Oh, I realize you got it up there.
Cash and cash return. 24% cap rate, 2% capture cash return, and you factor in 3% appreciation rate. The total return at the end of the first year, a mere 5%. First appreciation at the end of the first year is 13,800, right? Plus the annual net cash flow 11,000. So gross equity income was 24,000. This is your paper profit. When the 25,000 divided into 460K equals 5% turn on an investment. So what you take away from the 3 or 4 scenarios I just ran?
I don't know if that's a place I'd look into, that particular investment. I know that there are probably other properties that are much more investor friendly, but to put that kind of money down, $500,000 to only get back about a 5% return.
Yeah.
I don't know if that's something I would date. I think there's a lot of other places I can take that cash and make some money with it.
Absolutely.
Different parts of the country.
I'm getting to that momentarily. Before I get to that, some people are gonna try to confront me. They might say, "Oh, there are some better deals in Las Vegas other than this type of property. Oh, I can do a fix and flip. I can do syndication. I can do a burr strategy, and you buy a repeat refinance strategy." I get that. There's a lot of ways in each market. There are different type of investment you can do. I'm just using a cookie cutter, a decent neighborhood, B-class neighborhood, a single family home, 1,800 square foot, or B location, and using traditional investor loan leverage and all the scenarios I ran. Personally, I wouldn't buy this property, even if I have a $500,000. If I have $500,000 of cash, if I can do financing, here's what I would rather do. I would rather buy these cash flow homes instead. I would rather spread my money, use 25% down payment on this out-of-state property. I can buy 1 hour above Austin. I can buy single family home, new construction for $259K.
Nice.
For $1,950, even with the high property tax rate and all that. I can still cash flow, even with 7.3% 30-year fixed rate mortgage. I can still achieve a little bit of cash flow for the first year, right? But long term, you could make a lot of different ways of money, tax benefits, or loan pay down by the tenant, appreciation consistently over time, rental rates increase, or the whole 9 yards. But that payment of $70K, I can buy something like this and for cash flow. In Florida, I could buy something like this as well. I could buy a single family home in Central Florida for $264,000, brand new construction for $1,700 almost. The builder can give you a rate buy down of 4.75%. So at the end of the day, you can achieve a monthly positive cash flow of almost $300, and out of pocket is only $84. For example, you can also diversify and spread your money, 25% down payment again, with the amazing buy down. You buy these duplex brand new for less than $400,000. You rent for $2,600 on both doors, and the minus debt obligations monthly and expenses, paying an amazing 4.75% interest rate, mortgage rate, and your cash flow in this duplex, $526 monthly cash flow each year. And finally, you could also buy a fourplex brand new in South Texas for very fast growing $545,000 4 units, brand new. It rents for $5,400, which is per door, like $1,350 per door. $545K divided by 4 doors equals like $136K per door. It rents for $1,350, but you meet the 1% rent bottom ratio, the whole 9 yards, right? And minus your, even with 2% property tax rate and the insurance and the property management fee and other things, 25% down payment, even with 7.8% mortgage rate. At the end of the day, these fourplex, you have a monthly net cash flow of $773.
That's amazing, because I'm just looking at the down payment that it takes to get into something like that versus what we're looking at in Las Vegas. You can buy 3 of those fourplexes in Texas and have an amazing cash flow, and then with all the other benefits that are attached to it as well. Yeah. And have someone else having your tenant pay for your property.
My takeaway is you need to have a numerical format. You have to analyze your capitalization rate, cash return, rent to value ratio, and total return on investment. You have to apply these 4 formulas. I know I did not talk about these formulas that much, but on my other YouTube videos, again, investors, don't be so emotional. Just because someone tells you Las Vegas or Phoenix is a hot market, it doesn't mean it's going to be a hot market for investors. Some investors going to think, oh, I live in local area. I live in Phoenix, or I live in Las Vegas, or I live in LA, Southern California, a few hours of drive. I'd rather buy an investment property close to where I live. So in case anything goes wrong, I could drive over to my property a few hours away and fix the house myself, invest in it myself, and do my own property management, because I would buy somewhere close to me. I feel comfortable. I don't want to buy a rich property too far away. What are your thoughts on that?
You make a very good point. If you're going to be an investor, it really does get down to the dollars and cents, to the numbers. You can't make an emotional decision when it comes to buying real estate any more than if you were going to invest in a mutual fund. There's no emotion involved in investing in a mutual fund. But even individual stocks, there's some emotional tied to it, why people buy a lot of times. But with a property, it's strictly about the numbers, hence the term investment. So you can't get your emotions, your feelings, it's 2 minutes or 2 hours away from me. That doesn't make any sense. Otherwise, I would have never bought. And my property is 3,000 miles away. Yeah, it really just gets down to the dollars and cents and the numbers, the math.
Julie, I agree with you 100%. My kind of presentation, Julie, when I look at the YouTube videos, when I look at the social media, very few real estate gurus, just like myself, can break down this real case scenario. Do you agree that potentially the people that are watching this video, I'm saving you guys out there hours and hours
absolutely.
of research, potential research and due diligence? By watching this 20-minute video, I'm saving your real estate life.
I agree 100%. I mean, I am very thankful that we were able to meet you when we did finally make the decision to start investing. We would have never considered New York as an option. I've never even been to New York. That wasn't even on my radar. And even just the whole concept of investing out of my own state, which is California, which is all I've ever known. I think it is important, like you said, you have done the work so that we don't have to. All you do is present the option, and then we decided it was the best option for us. And yeah, that saved us tons and tons of time. It's been almost about 2.5 years ago when we started doing this. And we'd probably still be researching had we not met you. We would have never probably gotten into the market, and we would have never gotten into New York because we wouldn't have considered that as an option.
Julie, thank you for your kind words. By the way, people out there, I did not pay Julie to say these kind of things. She's saying this from her free will. Anyway, as we conclude this video, I hope you receive any value from this video. Please like and subscribe to my YouTube channel. Better yet, if you want to learn more about investment opportunities that we just disclosed to you, put your email into my website below. Become a subscriber to our network, free membership, and you'll receive a whole bunch of great information into your email pretty much almost every day.
Absolutely.
Thank you so much. And make a comment also, right? What are your thoughts about what we just discussed, and where are you watching this from? And if you find out did it that really transformed the way you evaluate rental properties from now on, now that you watch our video, right? Thank you so much, everyone. We'll see you next time. Have a nice day.
Okay, bye-bye.